On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope everyone is well. I'm back after a week or two off, and as always, it's been a busy time across financial markets, lots going on, lots of new developments, lots of things to talk about. So let's get right into it. First, let's look back on last week, and we'll start with global share markets. A bit of a mixed bag. In the United States, the S&P 500 index fell 2% last week. That's the worst week we've seen since April, and it was really driven by investors rotating out of some of those high-flying sectors and into some of the parts of the markets that look better value because they've been lagging. So the technology sector and the communication services sector, those are the two sectors that have doubled since the beginning of last year, and that's where many of those magnificent 7 companies reside. Those two sectors are down 6 or 7% from their recent highs, while we've had some of the other sectors across the US market, such as real estate, financials, industrials, that have all risen very solidly. So it's been an interesting period. The S&P 500 equal weight index has actually performed much better because it's more well spread and it's not dominated as much by those high-flying tech stocks and magnificent 7 stocks. So that index is actually flat over the last week rather than being down. And then you look at the Russell 2000 as an example, which is a company that's made up of smaller companies, and this index has not performed nearly as well as the headline indices, the tech stocks, the S&P 500 in recent times. The Russell 2000 is up over 7.8% over the past 2 weeks. So investors haven't been giving up on those high-flying stocks that have done so well for them over the last 18 months, but they have been choosing to do a bit of selling and recycling that money or rotating that capital into some of the parts of the market that haven't performed as well, that look better value. So it's been a very interesting period. Elsewhere, we saw the FTSE 100 in the UK down 1.2%. The Japanese Topix was also down 1.2%. European shares, emerging market shares, both fell by more than 3%. The Australian market was marginally higher, and the New Zealand market also bucked the global trend after posting its strongest weekly gain in 8 months the previous week. The NZX 50 last week added another 1.6%. So the NZX 50 is at its highest level in more than 2 years, and it's headed for its strongest monthly gain since November last year. So far in July, the NZX 50 is up 5.2%, which is a very strong gain. It's still about 9% below its 2021 peak, more if you exclude dividends. If you exclude dividends, then the index is still 15 or 20% below that peak. So we still haven't performed nearly as well as some of those other markets around the world, but we have seen some really positive signs just in the last few weeks. And I think that has come from a shift in tone from the Reserve Bank. Obviously, they had their meeting the week before last and a much more dovish tone. Plus, we've seen further indicators of weakening economic activity and slowing inflation, which we'll talk about shortly. That has fueled hopes of interest rate cuts coming sooner than expected. And our share market, as we all know, is quite an interest rate sensitive market. So it has responded accordingly and risen on the back of those developments. Quite a few New Zealand stocks have performed very well of late. There's actually 4 in the NZX 50 that are up more than 20% so far this month. Port of Tauranga, Serco, Tourism Holdings and Scalar up. So it's been a very strong period. Interest rates, in the US, interest rates were up slightly. The 2-year Treasury yield finished the week at 4.5%. The 10-year was little changed actually at 4.2%. Here in New Zealand, we saw the 5-year swap rate, which is a wholesale rate, in the week at just below 4%. And that's actually the lowest level we've seen since August 2022. And it's about 0.5% down from where it was at 2 weeks ago. So some big moves in interest rates that have also played into that share market strength that we've seen. Right, let's look back at some of the key developments last week. And on the local front, it was that June quarter inflation report. A bit of a mixed bag for the RBNZ, but more good than bad, I would say. First up, the annual headline inflation rate fell to 3.3%. That was slightly below market forecasts, also slightly below what the Reserve Bank was expecting, and it was down from 4% 3 months earlier. So at 3.3%, it's the lowest we've seen in 3 years. And we're not too far away from the top of that Reserve Bank target band of 1 to 3%. The less encouraging part of the inflation report was that while tradables inflation, that's imported inflation, while that was lower than expected, the non-tradables inflation that's been so persistent of late, that's the domestic inflation, it actually came in higher than expected for the quarter. And in the 12 months to the end of June, it's still up 5.4%, so not coming down as quickly as people would like. However, we do need to remember that this data is somewhat dated. It covers April, May, and June, and a lot has changed in the economy over the past few months, and forward indicators do suggest that we've seen a sharper drop-off in activity as well as inflationary pressures, and I think that will be more evident in the next inflation report, the one that comes out in October, that will cover July, August, September. So a bit of a mixed bag, but markets still responded to that. They liked the fact that that headline inflation rate is coming down, especially on the back of that shift in rhetoric from the Reserve Bank. So current market pricing now suggests that the OCR, the official cash rate, will end this year at either 4.75% or 5%. So a decline of at least 0.5%, possibly even 0.75% from current levels. And markets see an almost 50% chance of the first cut coming as early as next month in August. And a cut is fully priced by the October meeting. So where markets are at, and I think the general thinking is that you'll probably get 2 cuts, one in October, one in November, but there is an outside chance of a more proactive move coming next month. So really interesting developments. I've got an episode coming up later this week about OCR cuts, what might happen, what that might mean for investment markets, and how investors should be positioning for that and thinking about it. So keep an eye out for that one. But that was the key development from the week on the local front, that June quarter inflation report. It wasn't the only thing we got. We also had a dairy auction. Bit of a mixed bag there as well. The results saw the GDT index being stable, and that followed the biggest decline since August last year, a fortnight earlier. So the headline global dairy trade index was up 0.4%. Prices are about 5.5% higher so far this year. However, when you look at the underlying detail, it wasn't quite as good. You had some products strengthen, but milk powder prices are still under a bit of pressure. So whole milk powder, skim milk powder, both down. Housing market as well, pretty weak in June, as you would expect. The housing market has been very soft lately, and that goes hand in hand with rising unemployment, a weaker economy, lower confidence, and mortgage rates that are still at high levels compared to what we've seen over the last 10 years, 15 years. So the REINZ housing report did reflect that ongoing weakness across the market. House sales fell more than 30% in June. The days to sell nationally sitting at about 47 days, and the house price index at a national level slipped again. It was down 0.6% for the month. So that's the 4th month in a row that house prices have fallen. And since they stabilised in the middle of last year after that big slump in the previous period, they have rallied a little bit, then they've gone backwards. So national values are still 1.9% above that May 2023 bottom. That's where the market sort of bottomed out, but they have started falling again. So house prices are down 2% year to date. Internationally, we saw the European Central Bank meet last week, and after they became the first of the major central banks to cut interest rates last month, they paused at last week's meeting, as markets had expected. So in June, the ECB reduced its key policy rate from a record high of 4%, that's the highest since the euro came into being in the late 90s. They reduced it from a record high of 4% down to 3.75. That was their first cut since late 2019, and they held it firm last week. So we are expecting more cuts from the ECB. Markets see another two in 2024, and September is potentially the time when they might make the next move. The two cuts that markets are expecting would see the ECB policy rate end this year at 3.25%. We've seen good progress on inflation in Europe. That's what allowed the ECB to cut last month. But headline inflation hasn't been falling over the last few months. It's sitting at about 2.5%. That's where it was in June, and hasn't really fallen any more than that. So we do need to keep a close eye on developments in Europe to just make sure that inflation doesn't take off again or start rising again. That, I think, is why they've just paused at last week's meeting. They just want to see how things sit over the next month or two before they make the next move. Right, looking ahead, plenty going on this coming week, and we'll start across the world. Another inflation report due in the US, and this will be a highlight of the global calendar. It'll be the Personal Consumption Expenditures Index, the PCE inflation report for the month of June. And this is the Federal Reserve's preferred inflation measure, which means it's always very closely watched. It'll be out on Friday, so we won't get it until Saturday, New Zealand time, when our markets have closed. Investors are hopeful that it will follow what we've seen from the regular Consumer Price Index, the regular CPI inflation report, which obviously was softer than expected when we saw the June results there. So for the PCE this week, markets are expecting at the headline level no change for the month of June, so 0% change, no change. That would see the annual inflation rate, the annual PCE inflation rate at the headline level fall to 2.4%. So getting there, that would be down from 2.6% in May. Core inflation is expected to rise slightly for the month, 0.1% up, which would see the annual core PCE inflation rate slow to 2.5%. That'd be down from 2.6% in May, and at 2.5%, that will be the lowest since February 2021. This is one of the last key releases before the next Federal Reserve meeting. The Fed meets next week, and there won't be any change next week, but a cut is potentially not too far away. Like New Zealand, markets see at least 2 rate cuts before the end of this year in the US, so at least 2, possibly 3, same as New Zealand, and the first is expected to come, in the eyes of financial markets, in September. That's priced into the tune of 92% at the moment. So markets are very confident that we'll see the first cut from the Federal Reserve in September, which is only a couple of months away. We'll also be watching flash PMIs for June. PMI stands for Purchasing Managers Index. These will cover the month of July, I should say. Did I say June before? They're for July. So hot off the press. And this will be one of the most important economic releases of the week, because they will give us a good read on where economic activity is across the major economies. So most of them are out on Wednesday during the day, and then overnight you get the Aussie one first up at 11 o'clock on Wednesday morning. The Japanese release will follow later that day, just after lunch, and then we'll get the PMIs for the UK, Europe, and the US overnight on Wednesday evening. Last month, Europe, the UK, and Australia all saw their activity measures remain above break even, but they did slow from the previous month. The Japanese economy stalled. The US composite PMI actually rose, led by the services sector. So the US was strong, Japan stalled, and Europe, the UK, and Australia were all expanding, but at a slower pace. So it does feel like you're starting to see a few cracks appear in some parts of the global economy. So I think that's why these activity measures will be closely watched, because they're one of the first that we'll see for the third quarter of this year. We haven't really seen any other hard data yet, so this will be one of the first things that will give us a pulse check on the global economy. Right, locally, it is expected to be a fairly quiet week. We won't have a whole lot, but there will be more on the corporate front because the global reporting season will continue and there's plenty going on there. You've got almost 140 S&P 500 companies that are scheduled to announce results, and they'll cover a wide range of sectors, so plenty of things to keep an eye on. Alphabet, owner of Google, will be reporting. Coca Cola, LVMH, Tesla, Visa, Republic Services, Unilever, Nestle, 3M. So lots of companies and lots for us to monitor. So far, 62% have exceeded revenue forecasts and 80% have beaten earnings estimates. So it's been a pretty good start. And for the June 2024 quarter in aggregate, this is the June quarter that we're seeing these global results for, the earnings growth rate for the S&P 500, and this is relative to the June quarter of last year, so the same quarter a year earlier, the earnings growth rate is expected to be 9.7% at the moment. So that's pretty good. That would actually be the highest that we've seen since the fourth quarter of 2021. So, 2.5 years ago. So lots to keep an eye on, plenty for us to monitor. And we will be watching all of those things with interest, especially the local market, to see if that strength we've seen can continue and whether that sentiment remains positive. So hope that's useful. Keep an eye out for another episode later this week. We're going to talk about the change in OCR expectations, what that could mean for investors, for savers, for borrowers, and for asset prices as well. So lots to talk about on that front too. Right, thanks for listening, team. We'll speak again soon.
For more insights, visit craigsip.com.